A loan agreement is a contract between a borrower and a lender which regulates the mutual promises made by each party. There are many types of loan agreements, including facilities agreements, revolvers, term loans, working capital loans. Loan agreements are documented via a compilation of the various mutual promises made by the involved parties. Prior to entering into a loan agreement, the borrower first makes representations about his affairs surrounding his character, creditworthiness, cash flow, and any collateral that he may have available to pledge as security for a loan. These representations are taken into consideration and the lender then determines under what conditions, terms, if any, they are prepared to advance money. Loan agreements, like any contract, reflect an offer, the acceptance of the offer, consideration, and can only involve situations that are legal. A term loan agreement involving heroin drug sales is not legal. Loan agreements are documented via their commitment letters, agreements that reflect the understandings reached between the involved parties, a promissory note, and a collateral agreement, such as a mortgage or a personal guarantee. Loan agreements offered by regulated banks are different from those that are offered by finance companies in that banks receive a banking charter granted as a privilege and involving the public trust. Loan agreements are usually in written form, but there is no legal reason why a loan agreement cannot be a purely oral contract, although oral agreements are more difficult to enforce. For commercial banks and large finance companies, loan agreements are usually not categorized, although loan portfolios are often broadly characterized into personal and commercial loans, while the commercial category is then subdivided into industrial and commercial real estate loans. Industrial loans are those that depend on the cash flow and creditworthiness of the company and the widgets or service that it sells. Commercial real estate loans are those that repay loans, but that depend on the rental revenues paid by tenants who lease space, usually for extended times. More granular categorizations of loan portfolios exist, but these are always variations around the larger themes. The loan agreements originated by commercial banks, savings banks, finance companies, insurance organizations, and investment banks are very different from each other and all feed a different purpose. Commercial banks and savings banks, because they accept deposits and benefit from FDIC insurance, generate loans that incorporate the concepts of the public trust. Prior to interstate banking, that public trust was easily measured by state bank regulators who could see how local deposits were used to fund the working capital needs of local industry and businesses, and the benefits associated with those organizations' employment. Insurance organizations, who collect premiums for providing either life or property/casualty coverage, created their own types of loan agreements. Banks and insurance organizations' loan agreements and documentation standards evolved from their individual cultures and were governed by policies that somehow addressed each organization's liabilities. In the case of banks, the liquidity needs of their depositors. In the case of insurance organizations, the liquidity needs associated with their expected claims, payments. Investment banks create loan agreements that cater to the needs of the investors whose funds they attempt to attract. Investors are always sophisticated and accredited organizations not subject to bank regulatory supervision and the need to cater to the public trust. Investment banking activities are supervised by the SEC, and their main focus is on whether the correct or proper disclosures are made to the parties who provide the funds.